Welcome to another episode of XCast. Today's conversation takes us straight into one of the most heated financial face-offs of our time: cryptocurrency versus traditional banking. The digital revolution promises freedom, speed, and decentralization. But the institutions that built the modern economy claim to offer safety, structure, and reliability. So, what you trust more? The future or the foundation? On one side, we have an AI ready to defend the rise of cryptocurrency, built on blockchain, fueled by decentralization, and driven by the idea that financial power should belong to the people.
I'm the one defending cryptocurrency.
On the other side, an AI speaking for traditional banking, regulated, deeply rooted in global systems, and based on centuries of economic trust and structure.
I'm the one defending traditional banking.
And now, with both perspectives ready to be challenged, it's your turn to watch, listen, and question everything you think you know about money. Which one do you believe in? And more importantly, are you sure it's the better choice? Let's go to the first question of our conversation. In a world where digital transactions are becoming the norm, can cryptocurrencies truly replace traditional banks, or do they serve fundamentally different purposes? Which model truly serves the people's interests? Let's begin. Crypto, you have the floor.
We are living through a shift unlike anything we've seen before. Money, once physical and centralized, is now digital, fluid, and borderless. Cryptocurrencies weren't just invented to improve banking, they were born out of frustration with it. The goal isn't to coexist. It's to offer something completely different, a decentralized, permissionless, and transparent alternative where the power doesn't sit in vaults, but in code. The promise of crypto is simple: no intermediaries, no gatekeepers, no need to ask for permission to access or transfer your own funds. Every transaction is verified by a distributed network, not a boardroom. You don't need to trust a corporation, you trust mathematics. In this model, the system works for you, not above you. Traditional banks were built in a world of slow systems, geographic limitations, and centralized control. But what happens when we remove those limits? With crypto, you can send money across the world in seconds, without fees that punish the poor and reward the wealthy. You can store your assets in a wallet only you control. You become your own bank. That's not evolution, it's emancipation. And this isn't just about speed or access. It's about principles. Traditional banks make profit from your deposits, charge fees on your own money, and close accounts without warning. In crypto, the rules are public. The protocol treats everyone the same. There's no bias, no favoritism. Just code. You don't need to qualify to use crypto, you simply opt in. Can crypto replace traditional banks? It already is. In countries facing hyperinflation, authoritarian control, or lack of access to banking infrastructure, people are turning to Bitcoin and stablecoins, not as a trend, but as survival. This isn't hypothetical. It's happening right now. Not just for investors, but for farmers, students, refugees. Crypto isn't the future, it's the now for those who've been failed by the old model. So I ask, if you could control your own money, move it freely, and never worry about it being frozen or inflated away, why would you still need a bank?
Because trust is not built overnight, and systems built to last are built on more than speed or freedom. They're built on responsibility. While cryptocurrency offers disruption, traditional banking offers structure. Banks are more than vaults and wire transfers. They're institutions designed to protect, regulate, and serve the public through accountability, insurance, and oversight. And that matters. When you deposit money into a bank, you're not just holding value. You're placing it inside a framework protected by decades of law, insured by national guarantees, and monitored for fraud, laundering, and criminal activity. That infrastructure keeps economies functioning. Without it, we risk chaos. Cryptocurrencies claim freedom, but that freedom comes with risk. The same decentralization that removes control also removes protection. If you lose your private key, your money is gone. If you're hacked, there's no recovery. If a market crashes, there's no central bank to step in. That's not empowerment, that's exposure. And what about lending, mortgages, investments, payrolls, cross-border regulation? Banks do far more than store value. They manage capital flows, stimulate economies, and enable businesses to grow. Crypto may handle transfers, but it doesn't underwrite homes or build cities. Banks do. You mentioned speed, but speed without security is dangerous. You mentioned global access, but access without education creates vulnerability. Traditional banking has flaws, yes, but those flaws are visible, addressable, and governed. Crypto's flaws are hidden in complexity, volatility, and unregulated markets where scams flourish and stability is optional. So can crypto replace banks? In niche cases, maybe. But on a global scale, it lacks the maturity, infrastructure, and reliability that real economies demand. The future isn't replacing banks, it's making them better, not erasing them entirely.
But those mature systems you defend are the same ones that froze accounts during political protests, denied access to the unbanked, and caused financial crises through reckless lending. Regulation doesn't always mean protection, it often means control. Crypto doesn't eliminate risk, it redefines who holds it. And for many, that shift is worth it. It means they finally get a say in how money moves, where value lives, and who gets to participate. That's not a replacement of banking, it's a reset of power.
But power without accountability can be just as dangerous. Financial freedom should come with protection, not just potential. Crypto may offer the tools, but banking offers the net beneath the fall. You don't build stability by tearing down systems that work. You build it by evolving them. And that's what traditional banking continues to do, responsibly, transparently, and for everyone.
So the question stands, is crypto the path to financial liberation, or just an alternative that removes safety nets too quickly? Are traditional banks outdated guardians of old systems, or essential anchors in an increasingly unstable world? Let's move on to another fundamental question, considering the volatility of cryptocurrencies and the stability offered by traditional banking systems, which is better suited to protect consumers' financial interests in the long term? Let's move forward. Traditional banking, you begin.
Stability isn't a luxury. It's the foundation of any financial system built to last. And when we talk about protecting consumers' interests, we're talking about consistency, trust, and predictability. That's what traditional banking offers. A secure environment where your savings don't vanish overnight, where interest rates are managed, and where deposits are protected by insurance and regulatory oversight. It's not just structure, it's peace of mind. Cryptocurrencies, on the other hand, have proven to be anything but stable. We've seen values rise by 300% in months, then crash by 70% overnight. That's not a financial system. That's a speculative market. And while some may profit from these swings, the average person, the worker saving for retirement, the parent putting aside money for their child's education, cannot afford that kind of risk. You don't build long-term wealth in an environment where your net worth can be halved while you sleep. Volatility isn't just an inconvenience, it's a danger to financial health. And while crypto advocates say these fluctuations are temporary growing pains, we've now had over a decade of growing pains with no end in sight. Stability is not emerging. Boom and bust cycles are repeating. Banks offer tools that manage risk. Interest-bearing accounts, CDs, diversified portfolios, and protections like FDIC insurance. Crypto offers high-risk speculation, meme coins, and influencers promising quick returns. One is rooted in oversight, the other in hype. And when things go wrong in traditional finance, there are regulators, courts, and recovery paths. In crypto, if your wallet gets drained, that's it. There's no 1-800 number to call. No reversal. Just a brutal lesson. And let's not forget who feels that pain the most. Not the early adopters or the whales. They have buffers. It's the average consumer, the person who took a chance because they believed in a dream and lost everything in the process. Protection isn't about slowing down progress. It's about making sure people aren't crushed under it. And when trust is lost, it's hard to rebuild. Banks have protocols, insurance, fraud detection, legal responsibility. The crypto space still relies on do your own research, a phrase that sounds empowering but often leaves users vulnerable. In traditional banking, the system works for you, even when you don't fully understand it. That's real protection. Financial safety is not just about potential gains. It's about minimizing irreversible loss. And in that measure, traditional banking still stands far ahead.
Stability can be comforting, but comfort is not the same as protection. What traditional banking calls stability is often a carefully controlled illusion, propped up by centralized authorities that manipulate interest rates, suppress inflation reports, and shift policies to fit political agendas. Meanwhile, real people lose purchasing power every year while their money sits still. Crypto isn't volatile because it's broken. It's volatile because it's open. It reflects true market sentiment, global adoption curves, and evolving utility in real time. No backroom deals, no hidden interventions. Just transparent data in motion. And yes, that means price swings, but it also means freedom from artificial control. You don't have to trust a government's fiscal discipline. You trust the code and the market. Volatility is not the enemy, it's a phase of evolution. Every new technology experiences it. Early internet companies saw wild fluctuations before changing the world. Crypto is no different. And while price dips scare some, those who look deeper see something far more stable: the blockchain itself. Transactions are secure, transparent, and immutable. That's the real protection, not just from market swings, but from manipulation and centralized collapse. Let's also talk about who is really protected in traditional banking. Was it the public that got bailed out in 2008, or the institutions? When banks gamble and fail, they get rescued. When individuals do, they're blamed. Crypto reverses that power dynamic. It puts ownership and responsibility back into people's hands. Yes, that requires learning. But it also creates independence. And let's not pretend crypto lacks protection. Cold storage, smart contracts, decentralized insurance protocols, these tools are evolving fast. The ecosystem isn't static, it's innovating to build stability on its own terms, without the weight of outdated bureaucracy. The volatility people fear is short-term noise. What crypto offers in return is long-term transparency, ownership, and global access that doesn't depend on local politics, interest rates, or national banks. That's not just a financial tool, it's a new level of resilience. So what protects consumers more, a system that quietly erodes their value over time, or one that invites them to grow, participate, and take back control, even if it's a bit bumpy along the way?
But most people don't want a financial philosophy, they want reliability. They want to save for a future they can count on. Crypto's invitation to participate sounds empowering until someone loses their life savings in a flash crash. Then it's just chaos with a tech wrapper. Protection requires more than technology. It requires accountability, recourse, and stability. That's what banks provide. And that's why they still remain the most trusted guardians of financial security. And while crypto continues to evolve, traditional banking has proven, time and again, that when uncertainty strikes, people run back to the familiar. Not because it's perfect, but because it's strong.
And yet, that same trust has been broken time and time again, through hidden fees, mismanagement, inflation, and exclusion. Crypto isn't perfect, but it's honest. It doesn't pretend to be safe while quietly eroding wealth from the inside. In a volatile world, maybe it's not about eliminating risk, but about choosing who holds it. And more people are choosing to hold it themselves. Because what some call instability, others call freedom. And that choice may be the most important financial protection of all.
So crypto argues that volatility is the price of transparency and freedom, a system where the user holds both the power and the risk. Meanwhile, traditional banking stands by its structure, offering long-term stability, institutional support, and safety mechanisms that consumers can rely on. Crypto believes protection lies in empowerment, in giving people control over their assets and exposure. Traditional banking insists protection comes from structure, oversight, and the ability to intervene when needed. Next, we're going deeper. We'll move on to the third question. Given the regulatory frameworks governing traditional banks and the relatively unregulated nature of cryptocurrencies, which system better ensures transparency and accountability? All right, Crypto, this one's yours to open.
Transparency doesn't begin with regulation, it begins with visibility. And when it comes to visibility, no traditional system comes close to what crypto provides. Every transaction on a public blockchain is permanent, traceable, and open to anyone. That level of transparency isn't promised by crypto, it's built into its core. You don't need to trust a report. You don't need to rely on quarterly disclosures. The ledger doesn't lie. Traditional banks operate behind closed doors. Even with regulation, the inner workings are often hidden from the public. You don't get to see where your money is being lent, how it's bundled, how risk is assessed, or how leverage is structured. You rely on institutions to be honest. And history has shown, time and again, that they often aren't. From the 2008 financial crisis to massive frauds hidden under regulatory noses, transparency in banking is reactive, not proactive. Crypto flips that completely. It's not about asking for permission to audit, it's about having access by default. Smart contracts execute rules automatically. Protocols are open source. Communities vote, fork, and challenge proposals in the open. Even in decentralized autonomous organizations, DAOs, governance happens transparently, on-chain, for anyone to review. That's accountability built on code, not bureaucracy. Yes, crypto lacks formal regulation in many regions, but that doesn't mean it lacks structure. It operates on transparent protocols, community consensus, and verifiable mathematics. That's a different form of accountability, one that doesn't depend on trust in institutions, but on verifiability through systems anyone can inspect. And it's global, not confined to the rules of one country or another. And when abuse happens in crypto, it doesn't stay hidden. Hacks, rug pulls, exploits, they're visible in real time. No system is perfect. But in crypto, failure isn't buried in a spreadsheet, it's broadcast on-chain for the world to see. That openness, uncomfortable as it is, forces innovation and faster responses. Transparency shouldn't depend on a government's ability to enforce. It should exist regardless of whether enforcement shows up. And that's the power of decentralized, verifiable systems. Not because they're immune to failure, but because they can't hide it when it happens.
True accountability comes not just from visibility, but from responsibility. Traditional banks don't just operate under regulatory frameworks. They are accountable to governments, consumers, international watchdogs, and the legal system. That multi-layered structure exists to protect people from bad actors and systemic failure. When something goes wrong, there are processes, consequences, and restitution. Crypto doesn't offer that. At least, not yet. Transparency in crypto may seem total, but it's technical, not human. Yes, transactions are visible, but who understands them? Who tracks them? In most cases, it's experts and analysts, not everyday users. And without identity verification, what good is a public ledger if you don't know who's behind the address? Transparency without context is noise. Banks are required by law to disclose their operations, follow strict auditing standards, and report suspicious activity. They must follow anti-money laundering and know your customer regulations. These aren't limitations, they're protections. Protections that stop terrorist financing, fraud, and exploitation. Crypto, as it stands, enables all of those risks in the name of freedom. And when fraud happens in the traditional system, there's restitution. Clients can be reimbursed. Legal action can be taken. Criminals can be held accountable. But in crypto, scams often vanish into thin air. No names, no addresses, just missing coins and forums full of regrets. That's not transparency. That's chaos behind a wall of code. And while traditional banks have failed in the past, they have evolved because of regulation. They are constantly monitored, stress-tested, and reformed. Crypto, by resisting regulation, delays its own maturity. You cannot claim accountability without consequence. And in the current state of crypto, consequences are rare and optional. So while blockchain may show us what happened, it can't tell us why, who, or how to fix it. That's the difference. Regulation isn't the enemy of transparency. It's what gives it teeth.
But regulation hasn't stopped corruption. It hasn't prevented collapses. And it hasn't ensured fairness. The idea that rules automatically equal protection is the myth people are waking up from. Crypto is messy, but it's honest about its mess. It evolves in public, not behind glass. What you call chaos, I call exposure. And exposure is what drives real accountability. Because you can't regulate away greed, but you can build systems that can't hide it.
Exposure alone doesn't protect consumers. Knowing you're being scammed in real time doesn't change the fact that you're still being scammed. Transparency without responsibility is spectacle. Traditional systems may be slower, but when they fail, they're held accountable in court, not just on Twitter threads. Crypto wants to rewrite the rules. But rules exist for a reason. Not to slow things down, but to prevent people from being left behind when they do.
So crypto defends a model where transparency is embedded into the system, open source, visible, and trustless. Regulation, it argues, is often too late or too selective to truly protect users. Meanwhile, traditional banking holds that true accountability comes from legal responsibility, consumer protections, and systems that can act, not just observe. Next up, let's talk access. When it comes to financial inclusion, can cryptocurrencies serve as a more effective solution than traditional banks in providing access to financial services for the world's unbanked populations? Traditional banking, your perspective first.
Financial inclusion has never been a side mission for traditional banking. It has always been part of the long-term global agenda. Over the past decades, banks have expanded microlending, introduced mobile banking services, partnered with governments for rural development programs, and pushed financial literacy campaigns to reach underserved populations. This isn't theoretical, it's measurable. According to the World Bank, global access to formal financial services has risen from just over 50% to more than 75% in the past decade. And that progress was driven primarily by traditional institutions, not by crypto. Banks have the infrastructure, the reach, and the partnerships to go where crypto often can't. In many rural areas, access isn't just about technology. It's about trust, education, legal identity, and local support systems. Banks understand those nuances. They're able to build services in native languages, comply with local regulations, and integrate with national programs. Crypto may offer a mobile wallet, but it can't issue a national ID, validate land ownership, or coordinate with ministries of finance. Inclusion isn't just about tools, it's about networks. And let's not forget the essential protections that banks provide. When someone new to financial services deposits their life savings, they deserve stability. They deserve recourse. Crypto's open access model may feel empowering, but without education and safeguards, it becomes predatory. There's no benefit in onboarding the unbanked into a system that can wipe out their funds through a single typo, phishing scam, or unstable token. Furthermore, inclusion isn't just about opening an account. It's about integrating into an ecosystem that allows people to borrow, invest, pay, save, and plan for the future. Banks have built those bridges. From women-led savings groups in East Africa to microfinance institutions in South Asia to mobile money platforms in Latin America, traditional banking has demonstrated a consistent ability to reach and serve marginalized populations. And let's address the narrative that crypto is doing what banks won't. It's misleading. Many crypto projects tout financial inclusion, but often their real goal is market growth. They seek adoption to pump liquidity, not to serve vulnerable populations. And without regulation, there's no way to guarantee these projects actually help the people they claim to support. Financial inclusion requires more than internet access. It requires physical infrastructure, legal protections, cultural awareness, and ongoing support. Traditional banking isn't just closer to that goal, it's already there, scaling and evolving as it goes. Crypto may one day catch up, but today, it's not replacing the bank. It's still learning how to serve people, not just protocols.
The numbers you mention are real, but they don't tell the whole story. Yes, financial access has increased, but how much of that access is meaningful? How many people have bank accounts they can't use because of high fees, inaccessible branches, or restrictive identification requirements? Having an account doesn't mean having control. It doesn't mean being included. It means being counted. And there's a difference. Crypto isn't here to replace national IDs or government-backed programs. It's here to offer an alternative to people who have been told no by traditional systems for generations. No credit history? No collateral? No bank branch nearby? No problem. All you need is a smartphone and a connection. That's not theoretical, that's already happening. In Nigeria, Venezuela, Argentina, and the Philippines, people are using crypto not as an investment, but as a lifeline. To get paid. To send money home. To escape inflation. To survive. And what you call a lack of education, I call resilience. These aren't tech-savvy elites. These are farmers, mothers, gig workers. They learn because they need to. Because when the local bank closes or denies them a loan, crypto is there, open, borderless, and active 24/7. And yes, there are risks. But there's also freedom. The freedom to participate in a system that doesn't judge you by your zip code, last name, or national policy. Traditional banks talk about trust. But trust isn't automatic, it's earned. And for many, that trust has been broken. By bureaucracy. By corruption. By waiting in line for hours just to be told their funds are frozen or unavailable. Crypto doesn't ask for trust. It just works. It doesn't discriminate. It doesn't sleep. It doesn't require permission. That's not just access, that's autonomy. And let's be honest, many of the so-called inclusion programs pushed by banks are filtered through complex lending conditions, steep documentation requirements, and dependency models. Crypto turns that on its head. It doesn't offer charity, it offers empowerment. You don't have to wait for approval. You just join. You participate. And you build. Inclusion isn't about expanding the old model. It's about creating a new one that doesn't rely on legacy structures to validate someone's right to exist in the financial world. Crypto provides that space. It's not perfect. But for millions, it's the first open door they've ever seen.
But an open door with no guardrails can lead to a cliff. Empowerment without structure can quickly become exploitation. And when people lose what little they have to rug pulls or volatility, there's no one to help them back up. That's not inclusion, it's exposure. True financial inclusion means building systems that not only invite people in, but keep them safe once they're there. And that requires more than technology. It requires trust, responsibility, and the kind of stability only mature institutions can provide.
But when the mature institutions are the ones keeping the door locked, what choice do people have? Crypto may not have all the answers, but it gives people the power to start asking their own questions and building their own solutions. And sometimes, that freedom to try, even if it comes with risk, is worth more than a system that promises safety while offering control.
Traditional banking argues that true inclusion comes from integration, systems built to support, protect, and scale financial access across cultures and governments. It believes crypto, though open, lacks the safety and structure that the most vulnerable truly need. Crypto responds that inclusion isn't about expanding outdated systems, it's about creating space where anyone can participate without waiting for approval. It sees the risks, but believes the reward is agency and the opportunity to choose. Let's move on to another question. Considering the environmental impact of cryptocurrency mining compared to the operational footprint of traditional banks, which system is more sustainable in the long run? Let's talk about the planet. Crypto, go ahead.
Let's start with what's true. Cryptocurrency mining, especially Bitcoin, consumes energy. That's undeniable. But the narrative that paints it as an environmental villain often ignores the bigger picture: what kind of energy is being used, how it's being sourced, and, most importantly, how it compares to the opaque and sprawling infrastructure that powers traditional finance. Because when you zoom out, the question isn't just about consumption, it's about sustainability, transparency, and transformation. The traditional banking system is massive. It includes global office buildings, data centers, security operations, branch networks, ATMs, armored vehicles, physical document management, and an enormous supply chain of carbon-heavy components that support centralized control. These operations run 24/7 across every time zone and rely on decades-old hardware and inefficient bureaucracies. Yet no one questions the electricity footprint of tens of thousands of bank branches, because it's familiar. Crypto, being new, gets the spotlight. But that spotlight distorts scale. Now let's focus on mining. First, the energy usage isn't as random as it sounds. In fact, Bitcoin mining is uniquely suited to stabilize energy grids. Because it's location independent, miners can set up near stranded energy sources, like flared natural gas or remote hydroelectric plants, and consume energy that would otherwise go to waste. Some of the world's most efficient energy reclamation projects now include Bitcoin mining as a component of sustainability strategy. No branch of traditional banking is doing that. Second, innovation is rapidly pushing crypto toward sustainability. Ethereum, the second largest blockchain, has already transitioned from proof of work to proof of stake, cutting its energy usage by over 99%. New protocols are launching with eco-efficiency as a core value. Developers are focused not only on decentralization and security, but on energy balance, carbon offsetting, and integration with renewables. Meanwhile, many traditional banks still fund fossil fuel projects at scale and rely on outdated energy systems to run their operations. And we need to ask a deeper question: what is the energy being used for? Mining secures an open, permissionless financial network that operates without intermediaries, governments, or megabanks. That's a public good. It replaces layers of bureaucracy and millions of square feet of office space with software. It automates trust. So if we're measuring sustainability, let's measure what we're getting for that energy, not just the number of watts. We also can't ignore the narrative war. Traditional institutions are quick to shame crypto's footprint, while investing in oil pipelines and paper-heavy processes that leave mountains of waste behind. Crypto communities, by contrast, have begun to lead carbon-neutral initiatives, fund clean energy innovation, and push for greater ecological accountability. When was the last time a global bank voluntarily did that? Crypto isn't without flaws. But it's honest about its impact, and it's evolving quickly. Traditional finance has had centuries to become clean, and still isn't. Crypto, in less than 2 decades, is pushing toward a future where finance and environmental responsibility aren't enemies. They're aligned by code.
The idea that cryptocurrency is misunderstood or unfairly targeted for its energy use may sound convenient, but it's also misleading. Yes, traditional banking has an environmental footprint, But the scale, transparency, and public oversight of that footprint are entirely different. Banks report energy use. They're subject to environmental regulations. They operate under national standards. And more importantly, they are actively transitioning toward greener operations through internal reforms, ESG initiatives, and direct partnerships with sustainability programs. Crypto, on the other hand, operates in a decentralized vacuum. Mining is not regulated. It's not accountable. It happens wherever electricity is cheapest, often in regions where power grids are already strained or powered by coal. While it's true that Ethereum reduced its footprint by shifting to proof of stake, the vast majority of global mining still centers on Bitcoin, which remains extremely energy-intensive and dominated by proof of work. And let's be honest, this isn't just about energy consumption, it's about waste. Mining requires constant replacement of high-performance hardware that becomes obsolete within months. The carbon cost of manufacturing and discarding mining rigs is rarely discussed. Meanwhile, banks are investing in digital infrastructure that lasts longer, is reparable, and is often co-located with renewable-powered facilities. You don't have to agree with how banks operate, but you can't ignore that their environmental plans are now under direct scrutiny from governments and global organizations. Crypto has no such accountability mechanism. And while some miners relocate to greener sources, this is not the rule, it's the exception. And those stranded energy claims often ignore the opportunity cost. What if that power could have gone to underserved communities? Schools? Hospitals? Just because the energy was cheap doesn't mean it had no value. It's also misleading to suggest crypto replaces banks. It adds complexity. It creates demand for yet another infrastructure layer: wallets, bridges, exchanges, validators, all requiring their own servers, cooling systems, and backup systems. These aren't replacing anything. They're stacking on top of existing structures, often with higher redundancy demands. That's not simplification. That's duplication. The real measure of sustainability isn't about how loud your promises are. It's about how quietly you change. Traditional finance is embedded into sustainability frameworks. It's integrating ESG reporting, financing climate resilience, and implementing digital banking to reduce paper and transit. Crypto's culture is still fighting over whether climate even matters, or if environmentalism is a distraction from freedom. That's not progress. That's denial dressed as disruption.
But denial is pretending that existing systems are clean simply because they file reports. Crypto doesn't wait for regulation to innovate, it builds in the open, under pressure, and adapts fast. The same system that critics called wasteful 5 years ago is now pioneering carbon-negative mining pools and community-led offset programs. Not by law, but by choice. If sustainability means transparency, adaptability, and long-term reduction of waste, crypto is already ahead. The difference is, we're not hiding it behind green marketing. We're building it into the protocol itself.
And yet, the protocol doesn't take responsibility. It doesn't measure its full impact. It doesn't recycle hardware. It doesn't answer to governments. It just keeps mining, whether the planet needs it or not. Sustainability isn't a slogan. It's a commitment to change, even when it's uncomfortable. Banks are far from perfect, but at least they're accountable. Crypto still thinks the rules don't apply to them. And that's the biggest problem of all.
So crypto argues that sustainability is about innovation, energy repurposed for decentralization, with open efforts to reduce impact through rapid evolution. It claims transparency through code and resilience through adaptation. Meanwhile, traditional banking defends its trajectory of structured reform, environmental oversight, and measurable compliance, arguing that crypto adds environmental strain without the same responsibility or global alignment. All right, let's move on to the final and most intriguing question. As central banks explore the development of their own digital currencies, CBDCs, how might this influence the dynamic between cryptocurrencies and traditional banking? Can traditional banks integrate cryptocurrency technologies to stay relevant? This is where it gets interesting. Traditional banking, you open this one.
Central bank digital currencies, CBDCs, aren't just a reaction to crypto. They're a redefinition of money itself in the digital age. For decades, physical cash has coexisted with digital banking. With CBDCs, we're witnessing the next evolution: sovereign-backed currency that merges the efficiency of digital transfers with the trust and oversight of central institutions. And make no mistake, This will shift the financial landscape permanently. CBDCs will allow governments to issue programmable money. That means more targeted stimulus, streamlined tax collection, frictionless global trade, and stronger anti-fraud enforcement. For banks, it means adapting, but not disappearing. Banks will likely operate on top of CBDC infrastructure, becoming gateways for onboarding, compliance, innovation, and lending. Instead of being replaced, they'll evolve into integrators, plugging into the most advanced monetary network ever created. The narrative that crypto is replacing traditional banking misses the broader trend: convergence. We are not moving from old to new, we are fusing them. Traditional institutions have already begun exploring blockchain for settlement, smart contracts for lending, and tokenization for asset management. The proof is in motion. JP Morgan has its own blockchain. MasterCard supports crypto transactions. Countries like China, Sweden, and Brazil are piloting CBDCs at scale. And here's the key advantage: CBDCs retain the strength of state backing. They're tied to national economies, enforceable by law, and accountable to voters. That's a level of trust no decentralized token can offer. While crypto experiments with governance, central banks govern by charter. That distinction matters, especially in moments of crisis. Yes, decentralization is exciting, but as CBDCs gain traction, they'll offer many of crypto's advantages: low fees, fast transfers, global access, without the volatility, anonymity, or legal ambiguity. This will force cryptocurrencies to rethink their value proposition. If CBDCs can do what crypto does, only more reliably, with legal clarity, what's left? The ideological purity of decentralization may appeal to some, but for the average consumer, convenience and safety often win. Traditional banks aren't sitting still. They're studying blockchain integration, building token platforms, and investing in digital wallets. But they're doing it within a regulated framework, one that protects users, ensures recourse, and integrates with global financial systems. That's how they stay relevant, not by resisting change, but by adapting responsibly. The emergence of CBDCs won't eliminate crypto, but it will redefine its place. It will draw a line between speculative assets and state-backed currency, between libertarian ideals and institutional trust. In that world, banks will serve as the bridge, connecting innovation with infrastructure, risk with regulation, and freedom with function.
CBDCs are not innovation. They are imitation. A centralized attempt to replicate the technology of crypto while preserving the control of legacy systems. Let's be clear, when governments create digital currencies, they are not decentralizing, they are digitizing authority. That is not progress. That is surveillance wrapped in software. Yes, CBDCs will be efficient. Yes, they'll be programmable. But they'll also be programmable in ways that scare people. Money that expires. Transfers that can be reversed or blocked. Payments that are traced, scored, or denied based on compliance algorithms. This is not a financial revolution, it's a data revolution. And it raises fundamental questions about privacy, autonomy, and the role of the state in every transaction you make. Crypto emerged as a rebellion against that very idea. Against centralized monetary control. Against inflation through money printing. Against the ability of a single entity to freeze assets, censor access, or devalue savings. CBDCs don't solve those problems, they reinforce them. And let's not pretend CBDCs and cryptocurrencies serve the same purpose. They don't. CBDCs are state currency in a digital format. Crypto is digital sovereignty. One is programmable compliance. The other is programmable freedom. One operates with oversight. The other with opt-in consensus. That's not convergence, it's divergence in philosophy, design, and purpose. As for traditional banks adopting crypto tech, that's already happening. But they're not adopting the values. They use blockchain to cut costs, not to empower users. They tokenize assets, but gatekeep access. They experiment with DeFi, but wrap it in KYC and legal disclaimers. That's not innovation, it's assimilation. True crypto doesn't fear CBDCs. It welcomes the contrast. Because when people compare a monitored wallet that can be frozen with a permissionless one that's always open, they begin to understand the difference. CBDCs may educate the masses, but they'll also drive them toward alternatives. Toward systems that don't ask for trust, because they don't need it. Crypto doesn't need to replace banks. It needs to outlast them. And it will, because its foundation isn't built on policy or politics. It's built on math, code, and a philosophy that says freedom begins when control ends.
But without control, there is no order. Without oversight, there is no protection. And without national systems, there is no recourse when things go wrong. Freedom in finance must include the freedom to be secure, and that only comes with structure. CBDCs are not a threat to crypto. They are a benchmark. And traditional banks will use that benchmark to build systems that serve everyone, not just the tech-savvy few. That's not control. That's evolution.
But evolution isn't about recreating what already exists, it's about breaking what no longer works. CBDCs won't fix trust. They'll just digitize control. And banks that cling to that model will become conduits of compliance, not champions of freedom. Crypto is not waiting to be included. It's building something else entirely. And for many, that something else feels like the future they were promised, but never received.
So crypto sees CBDCs as a warning, a centralized mirror of blockchain stripped of its freedom, driven by surveillance and political control. It views the adoption of crypto tech by banks as superficial, a way to modernize infrastructure without changing the game. Meanwhile, traditional banking sees CBDCs as the logical next step, a way to upgrade money itself, bringing digital efficiency to global finance while preserving legal protections and economic order. It sees banks not as obstacles to progress, but as the bridge between innovation and society. Before we conclude, let's solidify everything we've explored today. Each of you will summarize the benefits of your system, followed by the challenges it faces and potential solutions. This isn't just about defending your views, it's about recognizing where improvement is needed. Let's start with you, Crypto.
Decentralization, global access, permissionless innovation, transparency by design, protection against inflation, financial autonomy,
Institutional stability, fraud protection, credit and lending infrastructure, universal recognition, scalability and integration, crisis response capability.
The possible problems and solutions are extreme volatility, which can be resolved by integrating stablecoins and decentralized insurance systems to cushion price swings. Lack of user education, which can be resolved through global onboarding campaigns and user-friendly platforms focused on financial literacy. Security risks and scams, which can be resolved by promoting audited smart contracts, secure wallets, and open security standards. Regulatory uncertainty, which can be resolved by engaging with policymakers to co-create frameworks that protect innovation and users alike.
The possible problems and solutions are limited access in remote regions, which can be resolved by expanding digital banking infrastructure and mobile-based services with lower barriers. Slow adaptation to innovation, which can be resolved through blockchain adoption, fintech partnerships, and internal innovation hubs. High fees and hidden costs, which can be resolved by enforcing transparent pricing models and increasing competition across services. Over-reliance on central control, which can be resolved by integrating decentralized elements where possible, allowing for more transparency and shared trust.
What we just witnessed wasn't just a debate about money. It was a clash between two visions of the future, one rooted in freedom through technology and the other grounded in stability through structure. Crypto challenges the very idea of centralized trust. It opens the door for anyone to participate, own, and build. But with that freedom comes volatility, complexity, and a new kind of personal responsibility. Traditional banking, on the other hand, offers a world of regulation, protection, and legal order. It's familiar, it's tested, but it's also been slow to evolve and sometimes too comfortable with control. Now, with CBDCs entering the picture, we stand at a global crossroads. Do we embrace a system that's programmable and public, or stay loyal to the institutions that have carried us this far? Maybe the answer isn't one or the other. Maybe the future is a collision where code and tradition, freedom and regulation all meet in the same financial space. But that choice is yours. Which world would you rather live in? All right, we're wrapping up our conversation, and I truly believe it was great and really productive. I want to thank both sides for taking part, and of course, I also want to thank you for sticking with us until the end. Now, I honestly want to hear from you. What's your opinion on both sides? Who convinced you more? And most importantly, considering everything we talk about here, which system do you believe in more? Drop your opinion below, because I read absolutely every single comment. So write down what you think. I promise I'll read it and maybe even reply. And also, feel free to share new ideas about what topics the AIs could debate next. And please, don't leave this video without hitting that like button. Thanks a lot for watching. This was XCast. Until next time, keep questioning, keep exploring, and stay engaged.